Welcome to the Stock Market Palantir. Today we are going to talk about Hood.
Yeah, Hood, a ticker that has really captivated the market lately. By late 2025, Robinhood is no longer just the gamified brokerage of 2021. It's a mature or, well, maybe maturing fintech player that has seen some really aggressive price appreciation. And that's fueled by strong Q3 earnings, these strategic acquisitions, and, some palpable macro tailwinds.
Exactly. The whole narrative has shifted pretty dramatically. The company has aggressively pivoted toward diversification and vertical integration, moving far beyond its initial reputation. So I guess the central question we have to address today is whether this recent re-rating, this significant expansion in its valuation multiple, is fundamentally justified by that strategic pivot, or if the valuation remains, dangerously dependent on volatile, ephemeral macro factors and high-risk market microstructure.
And that's where I'll be coming from. I'll be arguing that while the headline numbers from Q3 look impressive, the composition and the quality of that revenue are just precarious. I believe the current valuation is highly sensitive to cyclical downturns, specifically in crypto, and it still has these persistent structural risks baked into its reliance on high-variance transactional revenue and its market model.
And I'll be taking the other side. I think the rigorous operational execution and the diversification efforts really do establish Hood as a stable, high-growth financial platform. I believe the company has finally achieved the necessary operational leverage and structural stability to justify a premium valuation based on, fundamental maturity. It's signaling a permanent break from its speculative past. So to begin, the foundation of my bullish thesis rests squarely on the Q3 2025 earnings report. Released on November 5th, this report wasn't just a good quarter. It was the primary fundamental engine for the stock's dramatic re-rating. And it's because it successfully dismantled the long-standing bearish view that Robinhood was just, a relic of the pandemic trading boom. Total net revenues surged to $1.27 billion, which is a staggering 100% year-over-year increase. More critically, we saw the holy grail of valuation expansion, extreme operating leverage.
You mentioned operating leverage. Explain why that 100% revenue growth is so significant in context.
Well, because the operating expenses grew only 31%. That divergence is crucial. It means the company is successfully transitioning from a high customer acquisition cost model, where, every new dollar of revenue required significant marketing and infrastructure spend, to a much more efficient scaling model. And that, right there, is the hallmark of a mature technology company. It means that every incremental user or new product added in 2026 will drop far more profit to the bottom line, which fundamentally justifies a higher growth multiple than its legacy brokerage peers.
Okay, I acknowledge those figures on operating leverage are powerful. I do. However, while the overall revenue growth is undeniable, we have to look rigorously at the architecture of where that growth actually came from, and frankly, whether it's sustainable. If we decompose the $1.27 billion, sure, the stability metrics, net interest revenue, are certainly increasing, growing 66% to $456 million. But look at the volatile side of the ledger. Transaction-based revenues grew 129%, driven overwhelmingly by the most volatile and cyclical segments. Options revenue at $304 million, and crucially, cryptocurrency revenue at $268 million. That exploded 300% year over year.
But that's 77% growth in Robinhood Gold subscribers and the 153% growth in interest-earning assets, like margin loans. That provides stability. That net interest income floor is designed precisely to mitigate the cyclical nature of transactional revenue.
I'm just not convinced that floor is thick enough yet. When you have a quarter where $268 million, that's over 20% of your total revenue, comes from crypto, it validates the dependence on a highly cyclical crypto supercycle. It suggests that the massive price run-up in Hood shares is less about strategic maturation and more about being a high beta proxy for Bitcoin. If, or let's be honest, when, a crypto winter hits, those high-margin earnings disappear, and a $456 million NII floor simply cannot absorb that shock fully. It creates an enormous earnings risk that peers with more diversified core banking businesses just do not face.
I see why you emphasize that risk, but that volatility is precisely what the strategic vertical integration is designed to address. And that leads us to the structural moats the company is building. The Mayax DX acquisition is the definitive structural hedge against both regulatory risk and revenue volatility.
That's an interesting point, though. I would frame the integration a little differently. While the MIX DX acquisition does promise potent, novel revenues, analysts are projecting over $300 million annually from prediction markets alone. By allowing Robinhood to capture clearing fees and own the designated contract market licenses, the stock's current price action is heavily contextualized by the Trump trade.
Okay, can we clarify what you mean by the Trump trade in this context?
Absolutely. It's the anticipation of deregulation specifically concerning the SEC and CFTC in the U.S. political landscape. Robinhood's entire PFOF revenue model has, historically, carried a significant regulatory discount. That discount is currently being reduced because the market anticipates a more permissive environment regarding payment for order flow or new products like, leveraged derivatives and prediction markets. This macro-political tailwind reduces the perceived risk of a PFOF crackdown.
But the vertical integration is the permanent solution, independent of politics. Owning the entire stack, from the customer interface all the way to the clearinghouse, means Robinhood can internalize more margins and offer superior execution regardless of where the political winds blow.
If regulation shifts back, though, or if a new administration decides to target PFOF, that core transactional revenue model still faces a radical repricing event. And furthermore, while the vertical integration is ambitious, we can't ignore the operational challenges. The company is trying to combine a complex exchange entity, MIAXX, and a global crypto bourse, Bitstamp, simultaneously.
I see that as management confidence, not recklessness.
It's integration risk, plain and simple. Integration failures often stem from system incompatibility, cultural clashes, or mismanaging regulatory hurdles in new jurisdictions. The scale of combining two such diverse, regulated entities, one in traditional finance infrastructure and one in global crypto, is a massive undertaking that could easily distract management from maintaining that crucial 31% OPEX growth trajectory you celebrated. It presents a material operational drag risk that offsets the theoretical revenue gain.
All right, let's pivot to the microstructure, which you mentioned is a persistent source of skepticism. You focus heavily on the quantitative reality of the high off-exchange volume ratios, and I agree we do need to address the retail investor confusion around this.
We absolutely must. The data shows persistent structural realities that create mistrust among their own user base. On November 26th, for instance, the off-exchange volume ratio was 68.33%. That means nearly 7 out of 10 shares traded that day were executed away from public exchanges. Now, while we understand this is the reality of the PFOF model, it feeds the narrative that Robinhood users are trading in a dark pool environment, leading to confusion about price discovery. And compounding that is the high off-exchange short volume. 16.5 million shares on that same day, which remains optically concerning for anyone who isn't steeped in market structure mechanics.
I see why you highlight that data, but interpreting market microstructure requires precision, not just optics. The high off-exchange ratio is not an indictment of Robinhood's health. It is a feature of its client base, active retail traders, and its efficient monetization strategy. Look at the comparisons. Coinbase, another volatile retail-focused name, has a similarly high ratio at 53.40%. Contrast that with a diversified wealth management firm like Charles Schwab, which sits much lower at 21.97%. Robinhood's ratio simply reflects its focus.
But what about the massive short volume figure in the dark pools? Retail investors often view that as proof of manipulation or some kind of hidden bear attack.
And we have to clarify that fundamental misconception. High off-exchange short volume is often a proxy for high buying pressure within the PFOF ecosystem, not a massive, sustained bearish bet. Think of a high-frequency wholesaler as a high-speed inventory manager. When a retail customer places a market order, the wholesaler sells short into that demand to provide instant, guaranteed liquidity at the best possible price. They instantaneously fulfill the buy order and then immediately cover the resulting short position milliseconds later on a public exchange or internally.
So you're saying that high off-exchange short volume is essentially the grease
that allows for zero commission trading.
Precisely, it's an operational mechanism. The true measure of institutional bearishness is the actual short interest, the total shares outstanding held short. And that figure was moderate, around 5.85% of the float, with low days to cover. Furthermore, the market's structural confidence is validated by aggressive accumulation by smart money institutions like Vanguard, which increased its holdings by 25%, and BlackRock, which added 37.5% in the last quarter. Institutions are buying because they understand the fundamentals are improving.
Right. Institutional buying is a powerful stabilizing factor, I agree. However, those institutions also operate under strict governance frameworks. And that brings me back to the multi-class share structure. That remains a critical friction point that institutions typically penalize. The Class B shares held by the founders carry 10 votes per share, cementing their control and insulating management from any activist pressure.
But that structure facilitates the long-term strategic pivot we are discussing. It allows management to fund aggressive bets like the MIXDX vertical integration without fear of short-sighted activist investors demanding immediate quarterly returns.
But this structure raises serious governance questions that translate into a permanent valuation discount. By limiting shareholder accountability, the founders are insulated from scrutiny if this massive simultaneous integration of MIXDX and Bitstamp goes sideways. It allows potentially suboptimal operational decisions to be protected, which fundamentally increases the risk premium that institutional investors demand. And that risk premium acts as a drag on the share price regardless of how strong the Q3 earnings were.
That drag is being overcome by the maturing user base and the capital structure signals. Retail sentiment is pragmatically embracing Robinhood's platform, not just for speculation, but for its structural superiority in products like zero DTE options and the upcoming prediction markets. We are seeing the emergence of fundamental bulls even on platforms like Wall Street Bets, who are citing the net interest income floor and the Bitstamp integration. They're starting to view HOOD as the inevitable Charles Schwab of the Gen Z era.
I come at the retail shift from a different direction. The user base might be maturing, but the stock remains fundamentally linked to the volatility of decentralized assets. We can't ignore the fact that the company's massive revenue surge in Q3 was built on a cryptocurrency supercycle that may not last. And that means the stock is perpetually correlated with Bitcoin prices. While they are returning capital, repurchasing $107 million in Class A stock in Q3, which does signal financial health, that capital return doesn't negate the underlying high beta correlation risk inherent in their chosen expansion path.
But those buybacks are definitive proof that the company is not in stress. They're using their cash flow to enhance shareholder value while simultaneously funding aggressive growth. Unlike so many speculative high flyers, Robinhood has never executed a reverse stock split. This combination of returning capital while simultaneously funding aggressive vertical integration is the ultimate sign of financial maturity and operational leverage. It shows the company is confident it can generate sustainable cash flow even if transactional volumes were to dip.
The operational improvements are clear, particularly the cost control. But the revenue quality and the governance issues remain the sticking points for me. They have significantly improved their execution, but they are still profoundly vulnerable to two external shocks: a sudden regulatory shift on PFOF and a major cyclical downturn in the crypto market. The company's future valuation depends entirely on whether investors prioritize the stability of the net interest income floor or the volatility of the transaction-based revenue ceiling, which dominates the revenue mix today.
And I believe the operational execution, specifically the 100% revenue growth against only 31% operating expense growth, demonstrates that the company has achieved the leverage necessary to withstand those cycles, especially with the reliable gold subscription revenue now adding another predictable layer. Crucially, the strategic vertical integration through MIXDX fundamentally de-risks the enterprise by allowing Robinhood to capture proprietary utility-like revenue streams like clearing and prediction market services that are not reliant on third-party market makers or fleeting retail sentiment.
I maintain that HOOD remains a high beta, leverage play, highly sensitive to fragile macro-political shifts and cryptocurrency cycles, despite these fundamental operational improvements.
The structural dependence on high-variance revenue streams, specifically in options and crypto, means the current valuation premium is not as structurally sound as the net interest income growth suggests. The true test of their maturity lies ahead in the execution of these integrations during a potential market downturn.
So we have analyzed the bullish case based on the Q3 operational leverage and strategic acquisitions, weighed against the structural risks posed by market microstructure, the multi-class governance structure, and reliance on high-variance revenue streams like crypto and options.
The material presents a complex picture where financial maturation intersects with unique, high-velocity market structure dynamics, forcing investors to assess structural health against exogenous risk.
And the debate illuminates the critical need to distinguish between high off-exchange volume, which is really just a feature of the PFOF model serving retail flow, and genuine corporate distress signals, which are largely absent given the robust buyback program.
We leave it to the audience to decide if the operational improvements outweigh the structural vulnerabilities.
Thank you very much for hearing us. Let us know in the comments what is your opinion, and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.